Imagine waking up tomorrow morning, coffee in hand, scrolling through your phone, and you see a notification that sends a chill down your spine. It is not a market correction. It is not a political scandal. It is a message from your bank. Due to unforeseen liquidity constraints, all withdrawals over a certain amount have been suspended indefinitely. You try to log into your app, but the servers are down. You drive to the branch, and there's a line around the block, panic in the eyes of your neighbors. The ATM screen flashes a simple, terrifying message, temporarily out of service. It sounds like a scene from a dystopian movie, but if you know history, you know it is not fiction. It has happened before, and according to the world's greatest investor, Bob, it is not a matter of if it will happen again, but when. And when the music stops, as Bob famously says, only those with a chair will get to sit. The question is, will you be one of them, or will you be left standing? Today, we are going to dive deep into the warning signs, the mechanics of a banking crisis, and the specific, actionable steps you must take immediately to safeguard your wealth. We're not talking about hiding cash under a mattress. We are talking about the sophisticated financial strategies Bob has employed for decades to ensure that when the system creaks, cracks, and collapses, he does not just survive, he thrives. This is the most important financial information you will hear this year, so listen closely. To understand what to do, we first have to understand the fragile reality of the modern banking system. Most people look at a bank and see a vault. They imagine their money sitting safely in a secure box, waiting for them to come and get it. This is the single most dangerous illusion in finance. The reality is that when you deposit money into a bank, you're not storing it. You're lending it. You become an unsecured creditor to that institution. The bank takes your money and lends it out again, mortgages, car loans, business ventures, keeping only a tiny fraction in reserve. This is called fractional reserve banking. It works perfectly fine as long as everyone keeps their calm and leaves their money in the bank. But the moment a crowd gets spooked, the math falls apart. If every customer of a major bank walked in tomorrow and demanded their cash and physical bills, the bank would be broke before lunch. They simply do not have the money. This is not a secret, it is the business model. Bob understands this better than anyone. He has often quoted the saying, "Only when the tide goes out do you discover who's been swimming naked." And in the world of banking, the tide is the liquidity that keeps everything afloat. Now, you might be thinking, but what about FDIC insurance? Is not my money protected up to $250,000? This is the safety net the government wants you to rely on. And yes, for the average American with a standard checking account, it provides a layer of comfort. But Bob himself has warned us about the limitations of insurance and the false sense of security it can provide. First, the $250,000 limit is per depositor, per bank. If you have $500,000 in one account, half of it is technically unsecured. If you have $1 million, you're taking a massive risk. But more importantly, FDIC insurance only matters if the government has the funds to back it up instantly. In a systemic crisis where multiple banks fail simultaneously, a too-big-to-fail scenario, the insurance fund itself could be drained. We saw a glimpse of this during the 2008 financial crisis, and again in the recent regional bank failures. The government stepped in, yes, but they did so by printing more money, which leads us to the silent killer that Bob fears even more than a bank run, inflation. You see, if the banks restrict withdrawals and the government prints trillions to bail them out, the money you do have access to loses its purchasing power. You can get your dollars back, but they will not buy the same amount of gas, groceries, or real estate. Bob has been very clear about this. He has stated that inflation is a gigantic tax on anyone who holds cash. It eats away at your savings like a termite in the woodwork. So, if the bank freezes your assets, you're trapped. You cannot move your money into hard assets. You cannot invest in the dip. And you're forced to watch the value of your labor melt away while your digits remain locked behind a digital wall. This is the nightmare scenario. So, what is the Oracle of Omaha's advice? How do you structurally prepare so that you're never the one begging the bank teller for $50? The first and most immediate step is a concept Bob calls float and liquidity management, but applied to your personal life. You must stop viewing your bank as a storage facility for your wealth and start viewing it strictly as a payment utility. Keep only enough money in your checking and savings accounts to cover your immediate monthly expenses, perhaps a 3 to 6 month emergency fund at most. Anything above that amount is sitting ducks on the pond. It is at risk of being frozen, and it is at risk of being inflated away. If you have significant capital sitting in a low-interest savings account right now, you are making a mistake that Bob would criticize harshly. You are losing money every single day. The action item here is to sweep excess liquidity out of the bank. But where do you put it? You do not stuff it under your mattress. You move it into instruments that are liquid, but distinct from the traditional banking credit risk. This brings us to the second crucial step, Treasury Bills. Bob is a massive holder of U.S. Treasury Bills, especially during times of economic uncertainty. Why? Because a Treasury bill is a direct obligation of the United States government. It is not backed by a bank. It is backed by the taxing power of the federal government. While the banking system relies on the FDIC insurance fund, which has limits, treasuries are considered the risk-free asset of the world. If you buy a T-bill directly, you bypass the middleman. Even if your brokerage firm collapses, the asset is held in your name, not theirs. Bob keeps billions of dollars in short-term treasuries. He calls this having ammunition. When a market crashes and banks falter, opportunities arise, but you can only buy them if you have cash that is safe and accessible. Moving a portion of your wealth into Treasury bills ensures that if your bank locks its doors, you still own a government-backed asset that can be sold instantly for cash, or better yet, used as collateral. It is the ultimate liquidity safety net that sits outside the traditional banking leverage system. But we cannot stop there. The third step, and perhaps the most important for long-term survival, is to follow Bob's rule number 1, don't lose money. But rule number 2, as he says, is to never forget rule number 1. The best way to avoid losing money during a banking crisis is to own things that have intrinsic value, things that do not depend on a banker's promise to pay you. I'm talking about productive assets. This is where Bob's fortune truly lies. He does not keep his billions in dollar bills. He keeps it in companies like Coca-Cola, American Express, and Apple. He owns businesses that produce cash flow regardless of whether the banks are open or closed. If you restrict withdrawals, the world does not stop spinning. People still drink soda, they still use insurance, and they still buy iPhones. The businesses that provide these essentials continue to generate revenue. For the individual investor, the lesson is profound. You need to convert a portion of your sitting duck cash into equity in rock-solid businesses, or, if you're not a stock picker, in a low-cost index funds that track the economy. Real estate is another form of this. If banks lock down, you still own the roof over your head. You still own the rental property that puts cash in your pocket every month. These assets cannot be frozen by a bank manager. They exist in the real world. Bob often talks about the difference between price and value. During a banking crisis, the price of everything might plummet because people are panicked, but the value of productive assets remains. By owning these assets, you decouple your financial well-being from the solvency of the banking sector. However, there's a nuance here that many people miss. If you own these assets inside a margin account with a brokerage that also lends your shares out, you still have a counterparty risk. Bob advises us to be cautious about debt. If the banks restrict withdrawals, credit lines dry up. If you're highly leveraged, meaning you borrowed money to buy stocks or real estate, you will get a margin call. You will be forced to sell your assets at the absolute bottom to pay back the loan. This is how people get wiped out. The immediate action you must take today is to review your debt structure. Bob detests unnecessary debt. He lives within his means. If a banking crisis hits and credit freezes, you want to be the one holding cash and assets, not the one owing payments to a bank that will not even speak to you. Pay down high-interest debt now. Secure fixed-rate loans if you must borrow. Deleveraging your personal balance sheet is the single best way to insulate yourself from a shock to the banking system. It gives you the freedom to wait out the storm. Let us dig a little deeper into the psychology of this, because Bob is as much a psychologist as he is an investor. He understands that fear is a far more dangerous virus than any bank run. When withdrawals are restricted, the natural human reaction is to panic. You feel trapped. You feel helpless. But Bob teaches us to be fearful when others are greedy, and greedy when others are fearful. If you have taken the steps we have discussed, liquidity in treasuries, ownership of productive assets, low debt, you will find yourself in a position that very few people are in when the crisis hits, a position of power. While everyone else is lining up at the ATM, wondering if they can buy groceries, you will be calm. Why? Because your wealth is diversified across different pillars of the economy, not just the banking system. Now, I want to address a specific part of the title. Do this immediately. What is the one thing you can do the moment you finish listening to this speech? It is not to go to the bank and withdraw all your money in cash. That is impractical and unsafe. The immediate action is to audit your exposure. Look at your financial life with the brutal honesty of an auditor. Ask yourself, if my bank freezes my account for 30 days, what happens to my life? Can I pay my mortgage? Can I buy food? Can I pay my employees? If the answer is no, you are exposed. You need to diversify where your cash lives. Do not have all your eggs in one basket. Split your emergency cash between two different institutions, ideally two different types of institutions, a traditional bank and a credit union, or a high-yield savings platform that uses a network of banks. This diversification reduces the single point of failure risk. Furthermore, consider the physical aspect. While Bob does not advocate for burying gold in the backyard, he acknowledges the utility of having some physical cash on hand for emergencies. We saw during natural disasters like Hurricane Katrina that electronic systems go down. Having a few weeks' worth of physical currency is a prudent hedge against temporary gridlocks. It is not about hoarding, it is about redundancy. Systems fail, backups are necessary. Just as a pilot prepares for engine failure, you must prepare for financial gridlock. This is a topic Bob watches closely. In a purely digital currency system, the government could theoretically program money with expiration dates or restrict where it can be spent. If you are 100% dependent on the digital banking grid, you are at the mercy of the system operator. Bob has always been a fan of tangible, understandable businesses. In this new digital age, holding assets outside the traditional digital ledger becomes even more critical. We're talking about physical assets, commodities, and perhaps even decentralized stores of value that operate outside the control of a central bank. The key is to own something that acknowledges you as the owner, not the bank. Let us look at a historical case study that Bob often references, the savings and loan crisis of the 1980s and 90s. Back then, hundreds of thrifts failed. People who understood the signs early got their money out. Those who listened to the reassuring press releases lost everything. Bob observed that the CEOs of these failing institutions were often the last to know or the last to admit their ship was sinking. Do not rely on your bank's PR team to tell you when the bank is in trouble. By the time they announce a liquidity crisis, it is too late. You need to monitor the health of your bank. Look at their stock price if they are public. Look at their Tier 1 capital ratio, a measure of their financial strength. If the bank stock is plummeting or they're talking about borrowing from the federal discount window, you should be on high alert. The discount window is the emergency room for banks. If your bank is there, it is because they are bleeding. This is your signal to move your Treasury Bills or your excess cash to a safer harbor immediately. We also need to touch upon the concept of bail-ins. This is a legal mechanism used in Europe during the Cyprus banking crisis and written into U.S. law following the Dodd-Frank Act. In a bail-in scenario, if a bank fails, the money used to save it is taken from the depositors and shareholders, not the taxpayers. That means your deposits over the insurance limit could be seized and converted to equity in the failing bank, equity that is likely worthless. This is a critical distinction. The days of the government writing a blank check to save every depositor are likely over. The laws have changed. Bob reads the fine print, and so should you. Understanding that you're an unsecured creditor changes the game. It forces you to treat the bank not as a vault, but as a lending institution that you're doing business with. If your neighbor borrowed $5,000 and stopped paying you back, you would stop lending to him. If your bank is making risky bets with your deposits, why are you lending to them? This brings us to the ultimate strategy for protecting your wealth, the float strategy used by Bob's Berkshire Hathaway. Insurance companies hold float. money they hold now but will have to pay out later. They invest this float to generate more wealth. While you may not run an insurance conglomerate, you can apply the principle. You want to hold your money in a state where it is working for you, but is instantly movable. Avoid long-term lockup CDs that impose massive penalties for early withdrawal, unless you are absolutely certain you will not need that money. In a crisis, liquidity is king. Being able to move your money in milliseconds is worth more than a slightly higher interest rate. The ability to pivot is what separates the survivors from the victims. As we move toward the end of our discussion, I want to focus on the mindset required to navigate these turbulent waters. Bob is famously calm. He lives in the same house he bought in 1958. He drinks Coke, he eats McDonald's, and he reads for hours every day. He is not panicked by the news cycle. He knows that the economy moves in cycles. Winter always comes, but spring always follows. If you prepare your financial house for winter, you do not have to fear the cold. If the banks restrict withdrawals, it is not the end of the world. It is a shift in the rules of the game. Those who understand the new rules will prosper. Those who cling to the old rules, blind faith in the bank's promise, will suffer. So, what is the final takeaway? What is the one thing you do immediately? You take inventory. You look at your net worth statement. You identify your points of failure. You move your excess cash into short-term treasuries. You ensure you own productive assets that generate real value. You pay off your bad debt, and you keep a physical emergency fund. You stop thinking like a customer and start thinking like an investor. Bob did not become the richest man in the world by hoping for the best. He became the wealthiest by preparing for the worst. The banking system is a miracle of the modern world, allowing for trade and commerce on a scale we could never imagine otherwise. But it is built on trust, and trust, as history has shown us, is fragile. You cannot control the macroeconomic environment. You cannot control the decisions of the Federal Reserve or the risk-taking habits of Wall Street executives. But you can control your own allocation of capital. You can control your own exposure to risk. You can control your own reaction to fear. Imagine that scenario again. You wake up, the notifications are popping up, the lines are forming at the ATM. The neighbors are panicked. But you take a sip of your coffee. You check your Treasury bill ladder. It is safe. You check your brokerage account. Your shares in productive companies are intact. You have cash on hand for the week. You have no margin calls coming because you have no bad debt. You are not worried because you listened to the warning signs. You did not wait for the crisis to hit. You acted immediately. You secured your chair before the music stopped. This is the power of financial literacy. This is the wisdom of Bob. It is not about being smarter than everyone else in the room. It is about being more disciplined. It is about doing the boring work of protecting your downside so that when the upside comes, and it always comes, you are still in the game. Do not let your hard-earned wealth be held hostage by a system that does not guarantee its safety. Take control today, because if the restrictions come, there will be no time to prepare. The window of opportunity is open right now. Do not let it close. Secure your liquidity, own real assets, and sleep soundly knowing that no matter what happens to the banks, your financial future is in your hands, and yours alone. Thank you.